Preparing for a financial analyst at Dollar Tree interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to work as a financial analyst at Dollar Tree. I have built my foundation through financial analysis, Excel modeling, and translating operating data into practical recommendations. Dollar Tree interests me because small changes in traffic, pricing, shrink, inventory, or labor can meaningfully affect performance across a large store base. I would bring strong attention to detail, curiosity, and an ownership mindset. My goal would be to produce accurate analysis, explain the business drivers clearly, and help operators make decisions that improve sales, margins, and cash flow. While answering, connect your analytical background to retail economics, explain your interest in Dollar Tree's value-oriented model, and demonstrate comfort with forecasting, data interpretation, cross-functional communication, and operationally focused recommendations. Question 2. What financial metrics are most important for evaluating a dollar store retailer? I would start with comparable store sales, separating traffic from average ticket to understand demand quality. Gross margin, shrink, markdowns, and freight explain merchandise profitability, while labor, occupancy, and other store expenses drive operating leverage. I would also monitor inventory turns, in-stock rates, EBITDA, capital expenditures, and free cash flow. The key is connecting metrics. Strong sales growth is less valuable if it requires excessive markdowns, creates inventory buildup, or produces weak cash conversion. Make sure to cover comparable store sales, traffic, average basket, gross margin, shrink, inventory turns, labor productivity, occupancy, EBITDA, free cash flow, and how management balances growth with profitability. Question 3. How would you build a sales forecast for Dollar Tree stores? I would forecast existing stores using historical sales, comparable store trends, seasonality, traffic, and average basket assumptions. For new stores, I would use ramp curves based on format, geography, and historical openings. I would separately model closures, remodels, acquisitions, and calendar effects. Then I would create base, upside, and downside cases, test the assumptions against recent weekly trends, and reconcile the result to management guidance. I would update the forecast regularly as actual performance changes. In your answer, discuss store-level history, comparable sales, new store openings, closures, seasonality, traffic, basket size, promotions, regional differences, and scenario analysis around macroeconomic or operational changes. Question 4. What is comparable store sales growth, and why does it matter? Comparable store sales growth measures sales changes from stores open for the required comparison period, excluding much of the noise from openings, closures, and acquisitions. It matters because it shows whether the existing store base is becoming more productive. I would decompose comp growth into traffic and average ticket, then examine pricing, mix, promotions, and in-stock conditions. A positive comp driven only by price may be less sustainable than balanced growth supported by customer visits and healthy basket expansion. Be sure to mention the comparable store measurement period, traffic and ticket components, exclusion of new stores, promotional effects, and why comps provide a cleaner view of underlying store productivity. Question 5. How would you analyze a decline in Dollar Tree's gross margin? I would bridge gross margin from the prior period, separating merchandise cost, freight, shrink, markdowns, mix, and pricing effects. I would compare actual results with budget and prior year, then analyze categories, regions, and banners to locate the problem. For example, a margin decline could reflect elevated freight, aggressive promotions, unfavorable product mix, or inventory damage. I would quantify each driver, validate it with operating teams, and recommend actions such as assortment changes, vendor negotiations, or tighter inventory controls. Focus on merchandise cost, freight, shrink, markdowns, mix, pricing, promotional activity, currency, and vendor terms. Explain how you would isolate each driver through variance analysis and management discussions. Question 6. How do the income statement, balance sheet, and cash flow statement connect in a retail business? Sales and expenses create operating income and net income on the income statement. The balance sheet records the resources and obligations supporting those results, including inventory, payables, leases, and property. The cash flow statement starts with net income, adjusts for non-cash items, and captures working capital movements and capital expenditures. For example, buying inventory increases assets and uses cash before the related sale is recognized. That timing explains why profitable growth can temporarily reduce cash flow. Cover how sales and expenses flow into earnings, how working capital and capital expenditures affect cash, how inventory and payables link statements, and why cash flow can diverge from reported net income. Question 7. How would you evaluate whether a new Dollar Tree store is financially attractive? I would model the store's sales ramp, merchandise margin, labor, occupancy, utilities, shrink, maintenance capital, and working capital needs. I would include opening costs and test whether the location cannibalizes nearby stores. From those cash flows, I would calculate payback, NPV, and IRR using an appropriate hurdle rate. I would then stress traffic, average basket, rent, wage rates, and margin. A strong project should remain economically attractive under reasonable downside assumptions, not just the base case. Discuss upfront investment, sales ramp, gross margin, store operating costs, cannibalization, working capital, maintenance capital, payback period, NPV, IRR, and sensitivity to traffic or rent assumptions. Question 8. What is operating leverage, and how could it affect Dollar Tree's earnings? Operating leverage describes how fixed costs amplify changes in operating profit when sales move. Dollar Tree stores have relatively fixed costs such as rent and portions of labor, alongside variable merchandise and distribution costs. If comparable sales improve while the existing cost base remains stable, incremental revenue can produce meaningful profit growth. Conversely, weak traffic can pressure earnings disproportionately. I would quantify this through contribution margins and scenario analysis rather than assuming every sales dollar converts equally. Explain fixed versus variable costs, contribution margin, sales sensitivity, store-level expenses, and why modest sales changes can create larger or smaller earnings movements depending on the cost structure. Question 9. How would you analyze inventory performance at Dollar Tree? I would examine inventory turns, days on hand, sell-through, in-stock rates, aged inventory, shrink, and markdown exposure by category and distribution center. High inventory may support availability, but excess seasonal or slow-moving product ties up cash and risks markdowns. I would compare actual levels with sales trends, purchase commitments, and plan. The right recommendation might be reallocating product, reducing orders, or accepting a controlled investment in inventory when lost sales from stockouts would be more costly. Mention inventory turns, days inventory outstanding, sell-through, in-stock rates, aged inventory, shrink, markdown risk, seasonal goods, purchase commitments, and the relationship between availability and working capital. Question 10. What is working capital, and which items would you monitor most closely at Dollar Tree? Working capital represents operating current assets less operating current liabilities. At Dollar Tree, inventory and accounts payable would be central because the business purchases merchandise before selling it, while receivables are generally less significant than in many other industries. I would monitor inventory days, payable days, seasonal build, and vendor payment timing. Improving turns or terms can release cash, but I would distinguish sustainable improvement from delaying payments or understocking stores, which could damage future sales. Focus on inventory, accounts payable, accrued expenses, receivables, cash conversion cycle, seasonal purchasing, vendor terms, stock availability, and distinguishing operational improvements from temporary timing benefits. Question 11. How would you explain a variance between actual results and budget? I would begin with a bridge from budget to actual, separating sales volume, pricing, mix, timing, and expense rate effects. For store operations, I might isolate traffic, basket, labor hours, wages, shrink, and occupancy. I would identify whether the variance is recurring, temporary, or one-time, then validate the explanation with business partners. Finally, I would quantify the forward impact and propose actions. A good variance analysis should explain the past and improve the next forecast. Be sure to describe a structured variance bridge covering volume, price, mix, timing, rate, productivity, one-time items, accountability, and the difference between explaining results and recommending corrective action. Question 12. How would you determine whether a sales promotion was successful? I would compare promotional results with a realistic baseline, ideally using similar stores, periods, or products that were not promoted. I would measure incremental traffic, basket size, units, gross margin dollars, vendor funding, and inventory reduction rather than sales alone. I would also test cannibalization and whether customers simply shifted purchases earlier. A promotion is successful when its incremental contribution, strategic customer benefit, or inventory objective outweighs the margin sacrificed and operational complexity created. Discuss incremental sales, gross margin dollars, customer traffic, basket size, cannibalization, pull-forward effects, vendor funding, inventory clearance, and comparison against a credible control or baseline. Question 13. What would you include in a three-statement financial model for Dollar Tree? I would build revenue from store count, openings, closures, comparable sales, traffic, and basket assumptions. The income statement would include merchandise margin, freight, shrink, labor, occupancy, depreciation, interest, and taxes. The balance sheet would forecast inventory, payables, leases, fixed assets, debt, and equity, while cash flow would connect earnings, working capital, and capital spending. I would include balance checks, cash minimums, and clear assumption tabs so the model is auditable and easy to update. Cover revenue drivers, merchandise margins, operating expenses, working capital, capital expenditures, leases, debt, taxes, depreciation, cash balances, circularity controls, and integrated balance sheet checks. Question 14. How would you value a retail company using a DCF? I would forecast unlevered free cash flow from revenue growth, operating margins, taxes, depreciation, working capital, and capital expenditures. I would discount those cash flows using WACC and calculate terminal value through a perpetual growth or exit multiple approach. Then I would derive enterprise value, subtract debt and other claims, and add cash to reach equity value. Because retail valuations are assumption sensitive, I would present sensitivities for comps, margins, WACC, terminal growth, and capital intensity. Mention unlevered free cash flow, revenue and margin forecasts, taxes, working capital, capital expenditures, WACC, terminal value, discounting, sensitivity analysis, and reconciliation to enterprise and equity value. Question 15. What is the difference between EBITDA and free cash flow, and why does it matter? EBITDA is an operating earnings measure before interest, taxes, depreciation, and amortization. Free cash flow goes further by reflecting taxes, working capital investment, and capital expenditures, so it better indicates cash available for debt reduction, reinvestment, or returns to shareholders. A retailer can report attractive EBITDA while consuming cash through store openings, remodels, inventory growth, or lease-related needs. I would use EBITDA to compare operations, but rely on free cash flow to assess financial flexibility. Explain that EBITDA excludes depreciation, interest, taxes, and amortization, while free cash flow reflects taxes, working capital, and capital expenditures. Emphasize that cash generation supports valuation and funding decisions. Question 16. How would you assess the financial impact of closing underperforming stores? I would compare the store's expected future contribution with the economics of closure. The analysis would include lost sales, transferable customer demand, avoided labor and occupancy, inventory liquidation, severance, lease termination costs, impairment, and other one-time charges. I would also assess whether nearby stores capture some demand and whether closure affects distribution or brand perception. The decision should distinguish near-term accounting charges from recurring cash savings, then calculate payback and long-term value creation. Discuss lost sales, avoided operating costs, lease exit obligations, impairment, severance, inventory liquidation, customer transfers, cannibalization, one-time charges, and recurring cash flow improvement. Question 17. How can shrink affect Dollar Tree's financial performance? Shrink reduces the inventory available for sale and typically lowers gross margin because merchandise is purchased without generating expected revenue. I would analyze shrink by store, region, category, and cause, separating theft, damage, and process errors. I would compare trends with staffing, security measures, inventory accuracy, and local conditions. Recommendations could include cycle counts, receiving controls, targeted security, or process training. I would evaluate each action against its cost and the realistic merchandise value recovered. Cover theft, damage, administrative errors, inventory accuracy, gross margin, pricing, store controls, regional patterns, trend analysis, and the trade-off between prevention costs and recovered merchandise value. Question 18. Describe a time you found an error in financial analysis. In a prior analysis, I noticed a forecast variance that seemed inconsistent with the underlying sales trend. I traced the model and found that one regional assumption had been linked to the wrong historical period. I quantified the impact, informed my manager promptly, corrected the file, and reran the output before distribution. I then added a source check and reasonableness test to the process. The experience reinforced that speed matters, but controlled review matters just as much. Make sure to explain the situation, detection method, financial impact, root cause, communication, correction, control improvement, and how you maintained credibility without blaming colleagues. Question 19. How would you present an unfavorable forecast to a senior business partner? I would lead with the revised outlook, the size of the change, and the 2 or 3 primary drivers. I would distinguish confirmed facts from assumptions and explain the implications for sales, margin, earnings, and cash. Then I would offer practical actions, such as adjusting orders, labor, promotions, or capital timing, with estimated benefits and risks. I would remain direct rather than defensive, invite challenge, and agree on owners and follow-up dates. Focus on concise communication, facts before conclusions, quantified drivers, confidence levels, actionable options, scenario ranges, ownership, and avoiding surprises through timely escalation. Question 20. What would you do in your first 90 days as a Dollar Tree financial analyst? During the first month, I would learn the planning calendar, reporting tools, data definitions, store economics, and expectations for recurring deliverables. In the second, I would shadow operating partners, understand the drivers behind actual results, and independently reproduce key reports. By the third month, I would aim to deliver reliable analysis and identify one practical improvement, such as automating a reconciliation or sharpening a forecast driver. I would prioritize accuracy, responsiveness, and building trust across finance and operations. Discuss learning the planning calendar, reporting systems, store and supply chain operations, key stakeholders, recurring deliverables, data definitions, control expectations, and delivering an early process or insight improvement. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.